Hey traders, I'm Maddie from FX Scouts. So in this video, we're going to be discussing how to build a successful foundation for trading. And I'm going to be talking to you about how to identify different market conditions and then how to build a robust trading strategy. Now, this video is mainly aimed at beginner traders who maybe don't know where to start with creating a trading strategy, but it's also for intermediate and it could even be for advanced traders who want to brush up on the basics again. So let's dive in. As a beginner trader, this is very important to note. Forex trading is a very risky game and most traders lose money. I won't be providing any investment advice, but you must be aware that this video is for educational purposes only. Now, I know you're eager to jump in with fancy indicators and complex setups, but having a good foundation is crucial for trading success. You need to understand the context of your trades before you add indicators and before you look for your different setups. And to do that, you're going to need to understand the two different approaches to trading: momentum or trend trading, and then mean reversion trading. And in this video, I'm going to show you how to identify these different market conditions and then which trading setups work with these conditions. And lastly, I'm going to be covering risk management. So first you have to understand the market conditions or market behavior. And as I said, there are two pillars to understanding the market conditions. Firstly, you get momentum trading, and this is where the market is trending strongly upwards or downwards and you have a clear market direction. Then you get mean reversion. And this involves identifying overextended moves and anticipating a reversal. So if you imagine a rubber band being stretched, you know that eventually it'll snap back, and that's exactly what mean reversion is. The price goes up, hits a resistance, it goes down, hits support, and then reverts again up and down. And so basically mean reversion is where you see price moving between a support and resistance zone. How do you identify these conditions in the market? Well, with the trending market, you have a clear direction, and it's something you can quite easily see on the chart. So you have an upward or downward direction, and you have strong price action with consistent higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. You'll also find pullbacks and retracements, which are places that you can see here provide good buying or selling opportunities. Next, I want to look at how you identify a mean reversion market condition. So what you'll find is that the price oscillates between defined support and resistance levels or resistance zones. You'll also see that the price has no clear direction. It's not going up, it's not going down, it's in a range. But the range is quite defined in terms of the support and the resistance. And also what you find is reversals at these key support and resistance zones. So if you look at this chart of the loonie or the dollar, Canadian dollar, here you see support and resistance zones, and then you see the price break down below the support zone. But you see that the mean reversion conditions continued for quite a few weeks before this happened. Lastly, and something we never want to trade in, is the choppy market. So here you'll see indecisive price action with no clear trend, and it's kind of like choppy waves in the ocean. So in a choppy market, there's no clear direction and the price just chops around or chops up and down, and it trades within a very narrow range, or there can be high volatility and frequent whipsaws. But it doesn't give you any information in terms of where the market is likely to go. And traders that trade these markets often lose a lot of money very quickly. Now that you know how to identify these different market conditions, spend some time with them and learn to identify them on the charts yourself. And don't add any indicators to your chart. I would also print charts out on real paper so that you can see them, and you can actually draw on the charts, and then you can also start to identify at what times of the day the different market conditions occur. So look at the open and close of the day, look what happens in the middle of the day, and then you also may want to identify what happens with a news release. For example, when Donald Trump is posting on social media, what happens to the dollar then? You might want to also get out of a trade when you anticipate he might be posting something on social media, just so that you don't have that volatility. All these things will give you a lot of information, will help you to really formulate in your mind how the market works and how it reacts. Once you understand that, you can focus on refining your trading strategy. Now, if we look at momentum trading, as a beginner, I would keep it very, very simple. If you see momentum or a trend occurring, I would simply trade flags and pullbacks. That's it. I would start with very, very simple chart patterns. So pullbacks are basically areas where the price pauses during an uptrend or during a downtrend, and the price consolidates a bit, as you can see here, and then it continues in the same direction. This is very common, and in fact, it's how the market moves in waves. Again, print out a few charts so that you can see these and you can mark these areas out on the charts. Then if we look at flags, these are temporary periods of consolidation within a trend, and they're often characterized by a strong move, either up or down, which forms the flag pole, then a brief sideways movement, and then a breakout. For example, here's a bullish trend. You see the higher highs and higher lows, and you notice a pullback after a strong move upwards, and this signals a potential buying opportunity. If we look at mean reversion strategies, first you want to identify key levels. So these are levels where the price has historically found support or resistance. And here you can see the price clearly bouncing up to resistance, reversing and bouncing down towards support. Then you can look for reversal patterns, and these are double tops, double bottoms, and pin bars that signal a potential reversal. So for example, here we see price approaching a strong resistance level, and it could be a shorting opportunity if it fails to break through and reverses. And as I said in the beginning, you don't want to clutter your chart with indicators. But in this case, you may add something like a stochastic oscillator, and this just helps you to confirm the reversal. What I would do then is, again, on your printed charts, practice looking for these types of patterns. So in a trending market, you're looking for the pullbacks and the flags, and in the mean reversion market, you're looking for support and resistance, and then you're looking for those reversal patterns, the pin bars, the double tops, and the double bottoms. Last but not least, you want to manage your risk. This is one of the most important principles of trading. The general rule is that you don't want to risk more than 1 to 2% of your capital per trade, and you don't want to risk more than 5% of your capital per trading day. So on a $1,000 account, that's $10 to $20 per trade. So you want to keep your position sizes extremely, extremely small so that when you do lose your money, it doesn't hurt. It doesn't cause you to revenge trade or to overtrade and try and regain those funds because they're so important to you. You can let them go and you can move on, learn from your mistakes, and take the next trade. Remember, in the beginning, the goal is not to make big money. It's about learning to trade, figuring out how the markets work, and protecting your capital. I always think about what Chris Weston said in one of our podcasts. He said that the goal of the first year of trading is simply to keep your account open without blowing it up. And I think that's such good advice. You really need to just focus on keeping your account going for the year. And if you can do that, then you can start to build on your position sizes once you start to become consistently profitable. So in terms of risk management, the easiest way to manage your risk is to set a stop at the amount that you're comfortable losing. And many traders use the ATR, or the average true range, to do this. And I find it a very good way to set your stop loss. And the ATR basically measures the volatility of the instrument over a certain period. So if you use the default setting, and this would be 14 periods, and you're trading on the hourly time frame, it would measure the average true range over the last 14 hours. And a general guideline is to use 2 to 3 times the ATR to set your stop. For example, if the 14 period ATR on the Euro USD daily chart is 0.0233 or 23.3 pips, you could place your stop at 2 times the ATR, or at 46 or 47 pips away from your entry if you went short here. I've also made a video on how to use the ATR to set your stop loss. It goes into a little bit more detail than I'm talking about here. So if you want more information, you can check that out. Again, I'll put it in the notes below. Now, your profit target will generally be 1.5 to 2 times your stop to give you a risk reward ratio of 1 to 2 or 1 to 1.5, which is a healthy risk reward ratio. And so in this case, it would be at 92 pips from your entry, i.e. a 1 to 2 risk reward ratio. And these are the basic principles you can use to create a trading strategy. Obviously, you can get more complex, you can add more indicators, but in the beginning, I would say these are good foundations to build on. So in summary, you're going to look at market conditions, simply eyeball your charts, look at whether there are trending or momentum conditions, or whether there's a mean reversion happening in the market. Then you could look for your patterns. In a trending market, you'll look for flags or pullbacks. In a mean reversion market, you may look for you'll look for your support and your resistance levels, and you'll also look for reversal patterns. You'll look for double tops, double bottoms, and pin bars. Then you'll set your stops, and your stops will be 2 to 3 times your ATR, the 14-period ATR, and your profit target will be 1.5 to 2 times your stop loss level. And that's the foundation for getting a trading strategy going. As I said, you want to look at your charts, you want to identify times where the market moves, you want to look at the news and how that affects the markets. You may want to close your trades when the news is coming out, and I think that's a very good way to protect your capital as well. Thank you so much for watching. If you enjoyed this video, please give it a thumbs up. And if you're not already subscribed, please subscribe to our channel. If you have any questions, please don't hesitate to contact us. Our website is fxscouts.com, and I'll see you in the next video.